Hi, I'm Aaron Johnson, and today we're going to talk about mutual funds versus exchange traded funds or ETFs. And I want to talk a little bit about the differences of them, the positives and the negatives. But I also first want to talk a little bit about what is a mutual fund or an exchange traded fund and how do they work. And when you think of a mutual fund, I want you to think of a local mall. And inside that mall, they have a lot of different types of stores. They also have large stores and medium-sized ones and small stores. Then they also have those teeny tiny little kiosks that are in the middle. But the mall also has a mall manager, and that manager's job is to make sure that the mall stays full, but also has stores in there that go along with the goal of the overall mall and that are going to do well in that market. And a mutual fund is very similar. Every mutual fund has a portfolio manager, and their job is to make sure that the stocks and the bonds that are purchased within the mutual fund fit the goal and the purpose of that fund, right? So a couple of the pros and the benefits of a mutual fund is that they're very well diversified. Most mutual funds will own, if it's a stock mutual fund, will own anywhere from 50 to about 600 different stocks. They can buy international stocks, large, mid, small, or microchip companies. So they own a lot of different stocks. They can also own bonds, all depending on the type of mutual fund that they are. They are professionally managed as well. So active managers, mutual fund managers will buy and sell stocks and bonds based on the goal of those mutual funds, right? They can be very broad-based, where they're going to invest in, like total stock market fund, where they'll invest in large, mid, small, and international stocks, or they can be very narrow in scope. They can be set on a specific goal or an index, like energy sector or utilities, or just car manufacturers. So if you want to buy a fund that just invests in one area of the market, you can do that. The other nice thing is that you can invest in them for a very small amount of money. So most mutual funds will start for $25 to $100, and you can systematically add to them every single month if you want to. And that allows you to dollar cost average and not have to have a big chunk of money to just invest into the mutual fund. They are actively managed, which means that they can potentially outperform their indexes or their benchmarks with less risk, with less volatility. And that's a fantastic thing. Not every manager out there can do that. It's very hard for them. But there are some managers that do consistently outperform the benchmarks and their indexes with less risk. And that's why we would invest in a mutual fund that is actively managed. Now, some of the drawbacks to a mutual fund is that they only trade at the end of the day, meaning you can only buy or sell them after the market closes, and then you can buy or sell. The other drawback too is that also means that you don't know what price you're going to buy that mutual fund or what price you're going to sell the mutual fund. Because all the stocks have to settle at the end of the day after the market's closed, and then your funds are purchased to buy that mutual fund. Also, they're not very tax efficient, right? So if a mutual fund manager sells stocks inside of that account and there are gains, those gains are passed on to the client or to the mutual fund holder as capital gain distributions. Well, we've seen in 2020, utility funds were down and negative for the year, but the mutual fund manager sold stocks at a profit. So we had clients that had utility funds that had to pay taxes on those gains, even though that mutual fund didn't have a gain that year. Another drawback to mutual funds are the fees, right? We don't exactly know what the fees are going to be, and they're hidden within the mutual fund. You don't ever see a line item on your statement for the mutual fund costs, right? You have to go digging for it. You have to look in the prospectus, or you have to get online and look at what their costs are. And even then, they give you a range. They don't tell you exactly what that cost is to the mutual fund, because they don't really know. They'll kind of give you a guidance or a range, but it all depends on trading costs as well for them. So that's a drawback. And the way that those fees work is, let's say the fund expense is 0.5%, and that mutual fund returns 10%, they're only going to credit you with 9.5% gain. It's okay if you know that those fees are coming out, but a lot of people don't realize that. The other thing is that it is very hard to find out what the mutual fund currently owns. They give you a prospectus every quarter, and they'll update it on their website every quarter. But by the time it's updated, they've actually changed those holdings so that you don't know exactly what they own at any given point. So those are some of the pluses and minuses of a mutual fund. Now, looking at exchange traded funds, or ETFs, they have not been around as long as mutual funds have. They're kind of the newer, improved version of mutual funds, if you will. Some of the pros of them are that they are diversified, right? They own a lot of different stocks and bonds depending on the type of ETF that you own, just like a mutual fund. They are typically passive, meaning that ETF is going to follow a specific index or a specific sector. You can also invest for a small amount of money, and you can systematically reinvest into the ETF as well. Just like a mutual fund, they can be very broad range and very broad in scope, or very narrow. So they sort of like a Vanguard Total Stock Market Index. They can own all different types of stocks, or they can focus in on a sector. Unlike a mutual fund, though, they trade throughout the day. So you know exactly what you can buy it at and what you're going to sell it at. You can do options on a lot of ETFs. You can also set buy and sell limits, which makes hedging a whole lot easier with exchange traded funds. We know exactly what the fees are inside of them. Those don't typically change unless they are actively managed ETFs. They are also much more tax efficient because they trade like a stock. When you buy an ETF at $100 and you sell it at $110, you're going to pay the capital gains on that $10 gain that you have. And then whether you hold it short-term or long-term is going to depend on what type of taxes you pay on it. They can pay dividends, and most of the time they don't do capital gains distributions. It's just what you buy it for versus what you sell it for. And we also know what they hold, right? They're much more transparent that way. We know exactly what they're holding, what they're buying, and what they've sold, and you can get all that information right online. Now, because they are traded like a stock, that means that they are subject to buyers and sellers all throughout the day. So they can actually be a little more volatile throughout the trading day and overall, because as people buy the ETF, that price goes up, and as they sell, it goes down. So it could be more volatile than the actual index that it's following. ETFs are designed to track an index of the market, but not beat it. So you will always lag a little bit behind the index because of changes in indexes that happen, and also because of fees on exchange traded funds. So mutual funds have really, ETFs have really taken kind of all the good things and gotten rid of a lot of the bad things from mutual funds. Like I said, they're kind of the new improved version of mutual funds. And that's why a lot of advisors and professional money managers are using ETFs now, because they can specifically focus on overweighting different sectors or different areas of the market based on what's going on in the economy or their models. And they can do so much more tax efficiently in non-IRA accounts. So we've done a podcast on asset location and asset diversification. And again, even with mutual funds and ETFs, it's you really need to pay attention to asset location and where you're putting those investments, right? So a mutual fund might belong better in an IRA or a Roth IRA where you're not subject to capital gains distributions. ETFs can go anywhere they want, IRAs or non-IRA accounts. We just need to make sure that we're taking advantage of the market volatility in non-IRA accounts as well. But we still use both, right? Depending on the client's needs and their goals. We might choose an actively managed mutual fund for those accounts with that are a little bit smaller. Those larger accounts are going to go more toward professionally managed accounts that are going to use individual stocks or bonds or exchange traded funds. But I hope you enjoyed the overview of mutual funds versus ETFs or exchange traded funds. As I mentioned, we do use both. Please like and subscribe to the YouTube channel. And if you have any ideas for videos that you guys would like to see or kind of ask the advisor, please put it in the comments below and we'll make sure that we address those. So I want to thank you very much for your time today and have a good afternoon.